Hi there, my name's Allison, and we are going to get started here in 2 minutes. Waiting for everyone else to get on. All right, it's 12 o'clock. My name is Allison Dutcher, and I'm with Elevations Credit Union, and I am so excited to introduce Aaron Staufer today. He is a fantastic loan officer. He is also a sales manager, and he is an amazing teacher and presenter. At the top of your screen, there is a Q&A. If you have any questions throughout this presentation, please don't hesitate to put it in the Q&A, and I will make sure that I aggregate those questions to Aaron. So he'll see my screen come on and it'll alert him to know to pause, and I'll go ahead and get your questions answered. This entire presentation is being recorded. After this presentation, we will be sending you the recording along with the PowerPoint that Aaron is going to be presenting today. If you have any questions that you would like to ask privately, Aaron is incredibly open, and he would love for you to reach out to him and his team afterwards. But please utilize any question, the Q&A, ask any questions that you would like to throughout this presentation. With no further ado, though, I'm excited to introduce Aaron Staufer. So Aaron, go ahead and take it away. Thank you.
Yeah, thanks, Allison. I tell everybody that the key to happiness is low expectations. And after that introduction, I'm not sure that the expectations are so low. So lower them down a little bit. I think it'll do us all a favor. So thank you for spending your lunch with me. A little bit about me. So I am a mortgage sales manager, which means I lead a team of loan officers, teach them how to do this job, how to be the best that they can be. I also am an originating sales manager, which means I can originate my own loans. The education side of it is my favorite part of what I do. I really, really do enjoy the education side. I say that my love language is acts of service, and me educating is my way of serving. So it's a weird thing to be passionate about, but I am passionate about it nonetheless. So I've been in the mortgage industry now since 2009. Prior to that, I actually had my real estate license. I only survived for about a year in real estate. That was like 2008 to 2009, which is like the worst possible time to get into real estate. And one full year, I sold 2 properties. One sold for $45,000. The other one sold for $72,000. So after a year of really struggling in real estate, I was recruited to lending, and that turned out to be the perfect fit for me. I say that there's outdoor cats and indoor cats. The outdoor cats are the salespeople that just like to be like on the street, like hitting it hard, like talking to everybody. I remember my dad was in real estate, and we'd be at the gas pump filling up the car, and he'd literally be talking to the other people at the gas pump trying to drum up business. That was never for me. I'm more of a indoor cat. I like to be in front of my computer, crunch some numbers, figure out creative solutions. That's my jam. So when I'm not doing mortgages, I love to go on motorcycle rides. I'm a fair weather rider, so you won't see me out right now, but I love to go on rides with my Irish setter. He's hanging around somewhere in the sidecar. So if you ever see an Irish setter in a sidecar, that is me and Prince Finian. And then I love to go scuba diving. Love to play soccer a couple times a week, and I enjoy yoga as well. Yeah, a little bit about me. So my experience with residential rental property, and we are going to be talking about residential rental property. We're not going to be talking about commercial at all, but residential real estate. So I own a few rental properties myself. When I was in real estate, I was trying to cut my teeth and keep the lights on. I was also doing property management. So I've got a lot of experience, kind of real life, real experience on all that. I'll tell you some of the horror stories I came across so you know what to keep your eyes out for. I kind of went with the whole Warren Buffett strategy, which is invest in what you know. And I just happen to know real estate. So it suits me very, very well. Here's what we're going to be talking about today. Lengthy itinerary. So what is an investment property? Literally defining what an investment property is. What is the difference between residential and commercial? I will give you a referral for commercial if that's your jam. Why own an investment property? My job is really not to convince you either way. It's really kind of lay the groundwork, tell you the pros and cons of it, and then ultimately let you hopefully feel empowered to make a decision for yourself as to whether or not this is something that's going to suit you. Differences in the types of properties, condos, townhomes, single family residences, they all follow slightly different guidelines. We're going to be talking about that. One of the most common questions, one of the first investment properties that people typically acquire is the conversion of a current primary residence into an investment property. So we'll be talking about that and what you need to keep an eye out for there. Tenant management, what you need to look out for there. And then finally, we're going to get really into the weeds. Look at some different strategies, different approaches to calculating returns and comparing different types of rental properties with one another. So pretty packed agenda. If you have any questions, as Allison said, drop them in the Q&A. She'll pop on screen when she's got some aggregated, and then we will cover them all at once. So I mentioned what we are going to be covering because I also need to talk about what we won't be covering. Okay, so we will not be talking about how it compares to other investment strategies. I am not a wealth management advisor. My job is not to tell you, hey, the performance of bonds and stocks and mutual funds compared to real estate and comparing those different. It's not my job. I'll leave a wealth management advisor to try to convince you one way or the other what is and is not best for you. Specific tax consequences for you. More than happy to get into all of that off the presentation after the fact. When we were teaching this class in person, I would have a lot of people literally bringing stacks of tax returns and saying, hey, can you please review these? Like in the middle of the class. There's time and place for that. The time is not now. The place is certainly with me, but we can take that offline. And then why you should invest in real estate. Like I said, I'm not really trying to convince you either way. Okay. My job is to present the information as best as I possibly can, hopefully have you feel well informed and then make an educated decision. If you want to be convinced that you should invest in real estate, talk to a real estate agent. They'd be more than happy to talk to you about that. All right. So let's get into it. So let's start with what is an investment property? Okay. So lenders are concerned with three different types of properties: primary residence, second home, and investment property. A primary residence is a property you are buying with the intent of living in it within 2 months of closing, so 60 days, and you intend to live there for the next 12 months. That's literally it, okay? I plan on living there within 2 months of closing. I plan on living there for the next 12 months. You'll notice I mentioned intent, okay? That's all a lender can ultimately judge is your intent, okay? I had members that bought a primary residence and they unfortunately very quickly lost their job and they had to move out of state back to Wisconsin for a new job. They did not commit loan fraud, right? They even if they didn't live there within 2 months of closing, even if they didn't live there for a year, their intent was to do so. And that's all we can ultimately judge is intent. They did not commit loan fraud. They were forced to move back. There was not a problem with, the lender or the investor behind the loan of any potential fraud. No, it was their intent to live there. Circumstances changed, conditions changed. It happens. A second, as a property that's significantly far away from your current residence. Okay, now significantly far away is typically defined as 40 miles. And that's kind of as the crow flies. So don't have to take into account like all the roads and how they curve and switchbacks and all that. It's literally from point A to point B. Is that approximately 40 miles or more? Now, they do carve out an exception for geographically different enough areas. Geographically different. So in Colorado, that's really, really important because you could have a home, along the I-25 corridor and have a mountain getaway, a second home that's not 40 miles away, right? But it's geographically different. Any ski town is considered automatically geographically different enough. So second home is a property that's significantly far away or geographically different. And your primary intention is not to rent it out. That doesn't mean you can't rent it out. It means your primary intention is not to rent it out. Okay. There's a lot of different people you'll hear talk to, like, oh, well, you have to live there 20% of the time, or you have to live there 50% of the time. That's not true. There is no black and white answer to that question. How long do you actually have to occupy the property? It's really just based on, is your primary intention to rent it out? Yes or no. And then an investment property. An investment property is a property you are buying with the intent of renting it out. Okay. So I mentioned all of that because the rates are going to differ between these three different options. The down payment's going to change between these three different options. Qualification is also going to change between these three different options. A primary residence as a first-time home buyer, you can put as little as 3% down. As a repeat buyer, you have to put 5% down. So 5% down for a primary residence, very typical. A primary residence is also going to have the lowest interest rates. Second home, you have to put at least 10% down. The rates are going to be higher than a primary residence, but they're not going to be as high as an investment property. With an investment property, you have to put at least 20% down, and most investors find they have to do 25% down to make the numbers work because investment property rates are considerably higher. Okay, so really important. So 5% down, 10% down, 20% down. Lowest rates, second lowest rates, highest rates. Okay. From the government's perspective, why would they charge a higher rate for an investment property compared to a primary residence? The logic is higher risk, higher rate, right? There's a reason why people with a low credit score get a higher rate because they are considered higher risk. Okay. They have to have some kind of advantage to them, higher rates, to validate the risk that they're taking on. Okay. Well, from the government's perspective, if you have a primary residence and an investment property and times get tough, you're more likely to evict total strangers and sell that house than you are to evict your spouse or yourself. Okay. Again, considered higher risk, therefore higher rates. Now, there's also a big difference between residential and commercial. Okay. So residential, my arena, okay, is going to cover anything from 1 to 4 residential units. What does that mean? Single family residence, condo, townhome, duplex, triplex, or fourplex. Okay. It's not going to cover anything less than 1 unit, i.e. vacant land. And it's not going to cover anything more than 4 units, 5plex, apartment complex, however many units above 4 units. Okay. Anything less than 1 unit, vacant land, or anything more than 4 units, 5 units or more, is going to be considered commercial in nature. Now, that's a little bit different because commercial we associate with, well, it's commercial. It's a storefront. You know, you're selling tacos out of a storefront, or it's a gas station. But that's not necessarily the case. Commercial is just a catch-all for anything that does not fit this very specific definition of 1 to 4 units. Okay, so it could entirely be residential in nature. An apartment complex is residential in nature. However, if it doesn't meet that very specific definition of 1 to 4 units, it's going to be categorized as commercial. With residential, it has to be zoned residential or mixed, but residential has to be an acceptable use of that land. Okay, it can't be, one single family home, along Pearl Street, right? It's just commercial units after commercial units. Yeah, no, that's not going to work, right? It has to be at least zoned such that residential is an acceptable use of that land. Business units are accepted, obviously, for commercial, so that can be zoned industrial, commercial, whatever the case may be. The other big difference is the appraisal. With an appraisal on a residential property, the focus is on the value of the collateral, the value of that property, okay? Commercial, that's not the case. Their primary focus with an appraisal is on the income that that property can derive. There's a lot of different ways to calculate the value of something. One calculation is, what are the other properties in the area selling for? We'll compare it to those. That's a fair market value for that property. Another way to calculate value of a property is how much income could that property derive? How much income can that property create? That's commercial. Okay. Residential are typically backed by the government. Okay, they're backed by Fannie Mae and Freddie Mac. They are government-sponsored enterprises, or it's literally backed by the government, like FHA, Federal Housing Administration, USDA, U.S. Department of Agriculture, VA, Veterans Affairs. So since they're backed by the government, residential mortgages are going to have lower rates than commercial. Okay, commercial units are going to have higher interest rates than residential. And the reason why is because, again, higher risk. Commercial units are considered slightly higher risk. That's true. Also, since there's a secondary market, i.e. the government, for residential mortgages, lenders, Elevation's Credit Union included, we're very quick to lend out the government's money. And when it comes to our own, we're a little bit more protective of it, okay? So commercial units are going to have a slightly higher rate. They're also going to have worse loan terms. They're typically going to be adjustable rate mortgages, short-term loans, where the intention is, hey, we have to review your income docs every couple of years to re-up your loan, that kind of thing. They're constantly under review, those commercial loans. Residential, 2 years of W-2s, 2 years of tax returns, very common. Commercial, they want to see a little bit more history. 3 years is not uncommon. And then residential, we can close very quickly. 30 days is most typical. That's gone down to about 3 weeks in this more competitive market. We can close in as short as like 8 days. Really, I've done a couple of those in the last year. Commercial, they're not going to happen as quick. Okay. Plan on longer processing times. 45 days is like the absolute shortest those can typically be turned. Talking about residential, that is my sphere of influence. That's my area of expertise. If you are interested in commercial, please call Todd Payock. He's our VP of Commercial Lending. This is our general phone number, and that's his extension 1517. Okay. And again, as Allison mentioned, we will be sending this out after the fact, so you'll have his contact information. I mentioned indoor cats and outdoor cats, right? I'm in front of my computer. I'm answering phones all day. Commercial lenders are outdoor cats. Okay. So if you don't get a hold of him right away, please call back again. You are not pestering him. He's used to it. It's kind of to be expected. Okay. All right. So why have an investment property? Okay. Why have an investment property? Well, there's a couple different investment strategies. Okay. There's buying for appreciation, and then there's buying for cash flow. I've got a couple kind of extreme examples of both. Most real estate includes both types, right? It's some portions of appreciation. It's also going to have some portions of, cash flow as well, hopefully. Most is not entirely one or the other, right? But it's worth having a quick conversation on this, because when you do buy rental properties, you kind of have to have in the back of your mind what your primary intention is. Is it appreciation or is it cash flow? Okay. So let's talk about appreciation real fast. The most comparable like investment is a growth stock, right? You're buying Tesla at the very beginning, you're hoping it's going to increase in value, and then you're going to sell it at a future higher value. That's the appreciation, right? That difference. Less emphasis is on cash flow, right? You might not be receiving any money from it at all. Talk about that in the next example here. But your priority is on appreciation, not on cash flow. A fix and flip is the most extreme example, right? You're buying a house, it's beat up, you're planning on improving the house and then selling it at higher future value. You might not, again, have any cash flow. You might not rent out that property one single day. You might not receive a single dollar of income from it until you actually sell it, okay? Most extreme example of that. Another path is buying for cash flow, okay? Most comparable like investment would be a dividend paying stock, right? You can buy utility stocks. They are limited to how much they can increase, but they will pay you dividends. They will pay you money on a consistent basis. Okay, so it's like a dividend paying stock, right? Less emphasis is on appreciation. It also tends to be a longer term strategy. Cash flow short term doesn't mean a whole lot. Cash flow long term can certainly help. The most extreme example of that I've heard is I have a friend that buys Section 8 housing in Missouri. Okay, so he buys properties literally for like $25,000, $30,000 a pop. I asked him like, hey, do those appreciate at all? He's like, oh, good grief, no. They don't increase in value at all, but they cash flow very, 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 very well. So that's the most extreme example of that. Fix and flip, most extreme example for appreciation. Buying Section 8 housing is like the most extreme example for cash flow. Okay. Pros and cons of real estate. We'll start with the advantages. Okay. Biggest advantage. And if you only got one thing from the seminar, how does real estate differ from other investment strategies? What is the single biggest advantage? It's this right here. Okay. It is leverage. Real estate is extremely highly leveraged. Okay. If you wanted to go buy stock, unless you're buying stock on what they call margin, you are typically putting forth 100% of the money needed to acquire that stock. If I wanted to go buy Apple stock today, I'd have to fork over dollar for dollar the amount that stock is costing, right? Not the case with real estate. With real estate, it's leveraged. With real estate, you might only have to put down 20% or 25%, right? Or if you buy a primary residence, only 5%, right? 3% of your first-time home buyer. The lender is forking over the remainder, but you get to receive 100% of the appreciation. When you go to sell that house, the lender doesn't receive a portion of your appreciation. It doesn't work that way, right? You get 100% of the appreciation. That's what's magical about investing in real estate, in my opinion. And we'll look at some numbers and you'll be like, wow, that is a huge difference. And when you look at the return on investment with taking into account leverage, it makes all the difference in the world. Okay. So again, like most investments, you have to fork over 100% of the money. Not the case with real estate. You can buy it with 3%, 5%, 20% down. So single biggest advantage. Leverage allows you to do something you otherwise wouldn't be able to do unless you're paying cash, right? It allows you to, if you're the consumer and you have a home loan, it allows you to lift this really heavy house. Another advantage of real estate is diversification. There's this common misconception that, hey, during recessions, real estate doesn't perform well. That's not the case at all. Everybody looks at 2008 and says, hey, that is the case. There's a big difference there, right? In 2008, 2007, 2008, 2009, real estate was the virus that caused the recession, right? That recession was created because of bad lending practices, a bad real estate market, some very poor foundational pieces, right? Historically, 2008, 2009, taken out of the equation, right, the Great Recession, real estate actually performs very well during recessions. And why would it do? Substance. It offers real value. It's concrete. I can touch it. It occupies space. And last time I checked, they're not making any more of that. It's also, for most people, not a discretionary purchase, right? For most people, real estate is not something that they just willy-nilly go buy. No, it's something you live in. It's something you occupy in it. It's not a discretionary purchase for most people. So it tends to be a very safe, historically, investment. 2008, taken out of the equation, right? During recessions, real estate does tend to perform very well. Real estate also does not move in lockstep with stocks or bonds, okay? The values of real estate, COVID-19 happened, right? Stocks plummeted. Well, real estate performed very well. So it just doesn't move in lockstep with any other. If you are heavily invested in stocks, bonds, mutual funds, that kind of thing, and you are looking for further diversification, real estate may be a valid option for you. Another big advantage of real estate is the tax benefits, okay? Again, I'm not a CPA. You'll probably hear me say that a couple times. I'm not a CPA. However, there are some very obvious advantages to real estate when it comes to tax time. Okay. So when you go to file your taxes, you will fill out what they call a Schedule E. Schedule E is an Edward. Okay. Taxes. You will have the rent at the very top. This is actually a snapshot from one of my rental properties from my tax returns way back when. So rents received, you will put at the very, very top. You will then have all of your deductions listed out, okay? Cleaning and maintenance, insurance, management fees, if you have a property manager, mortgage interest, okay? Mortgage interest is indeed a deduction, even if you're not claiming your interest on your own personal deductions, it is always going to be a deduction on your rental properties. That's pretty important to know. Taxes, property taxes, okay? And this one down here, depreciation. Depreciation always throws people for a loop, okay? So what is depreciation? And why is it important? So depreciation can be handled in a couple ways. Which way is better for you? Ask a CPA. But depreciation is handled in two different ways. Number one, you could take it as one lump sum when you go to sell your house. Okay, that is an option. Another option is you can take it as a yearly deduction. Now, what is depreciation? Depreciation is Uncle Sam saying that over time, if you just left a property alone, it would eventually erode and fall into disrepair and eventually lead to being worthless. Okay, it's the reason we all do repairs on our home, right? If we didn't, the house would fall apart, right? So here's what they do. They allow you to take the value of the structure when you buy the property, not the land, not the land. Okay, the land will not depreciate. Land is still going to be worth what it's worth. If there was a catastrophic issue with your house that burned to the ground, your land is still worth what it was worth, theoretically. Value of the structure, you divide that over 27.5 years. Why 27.5? Ask Uncle Sam. I do not know, but that's their calculation of, hey, over 27 and a half years, the value of the property would be nothing. Can then take that as an annual deduction on your tax returns, okay? So what you typically do is you'll look at the sales price that you bought the house for, you go on the county assessor's website to find out how much the land is valued at, subtract that out, divide that over 27.5, and you can take that as an annual deduction on tax returns. Here's why that's important. If I did not have this depreciation in here, right? This number down here, which is like my income from the property, right? Instead of being negative $642 and reducing the amount of taxes I have to pay, this would be positive, right? If you take minus 642 and you add 4,258 to it, it'd be positive. Now all of a sudden I do have positive income down here, and I would have to pay capital gains on that income. So this is a way to reduce your tax liability. Depreciation is a wonderful tax deduction. Again, you can take it yearly, you can take it one time at the very end. Which is better for you? Ask your CPA. It really kind of depends on what you're doing. Also depends on where they predict your income is going to be. For me, I'm never planning on selling my properties, so I might as well take it now. I'm never going to sell that property. I don't want to see it at the end. I'm just going to hold on to that and take the reduction while I can. Another advantage potentially with investment properties is what they call a 1031 exchange. Okay, so this is kind of interesting, and it is very unique to real estate. This actually harkens back to like way back when there was kind of this like suburban boom going on, and people were moving to cities in droves. And some people wanted to get out of the city and move to the country, and some people wanted to move out of the country and move to the city, right? So they would literally exchange properties with one another. And the government carved an exception in their tax guidelines that allowed for people to do that without having to immediately pay capital gains. So here's how it works now. Very different than what it used to be. Here's how it works now. If you are selling an investment property, instead of having to immediately pay capital gains on that investment property sale, you could transfer that property into a new property and defer paying capital gains. Defer is the key word. You are not going to avoid paying capital gains this way. You are simply delaying paying capital gains. Okay. We see this all the time when somebody's living in Texas or California or Florida, and they're moving to Colorado to retire to get close to their grandkids or whatever because it's amazing, right? They want to bring those rental properties with them, right? It's going to be really hard to manage properties all over the country. Why not bring those properties with them essentially? So they can do a 1031 exchange and delay paying any capital gains associated with that. Now, it's very important that you execute this correctly, okay? Number one, you have to identify a qualified intermediary. That's fancy speak. What the heck does that mean? Qualified intermediary is a 1031 exchange company, okay? In Colorado, we use a lot of title companies, land title, Fidelity National Title, Heritage Title. Each one of those title companies has a 1031 exchange company that they work with, okay? So if I was starting and I was going to look into this, I would immediately start by saying, what title company does my real estate agent use? Great. Who do they use for a 1031 exchange company? And start having these conversations. So you'll identify a 1031 exchange company. You will list the property that you're going to sell. Okay, I'm going to sell 123 Main Street. The second that sells, okay, so you sell 123 Main Street, the proceeds from that sale cannot pass to you. Absolutely critically important for this to work. They cannot pass to you. Instead, those proceeds will go to that 1031 exchange company that you identified. Okay, they will hold on to those proceeds for you. Then you have 45 days from when you sell that property to identify a replacement property. You can actually identify multiple replacement properties. More on that in a second. You've got 45 days to identify a replacement property from when you sell that property. And from when you sell that property, you have 180 days to close on a new property. When you go to close on that new property, the 1031 exchange company will transfer the funds for you to the closing table. So the funds never go to you. Very, very, very critically important. Okay. There's a lot of time frames in here that matter a lot. You have 45 days to identify a property, 180 days to close on a property. Honestly, this is really long. 45 to 180 days, like that's a really long window. Most transactions close, like I said, within like 30 days. So I doubt you'll see all this, but it's possible. This is a 1031 exchange company. I could sell properties from Florida, California, bring them to Colorado with me, buy properties in Colorado that I can manage locally, right? That's the whole kind of idea around this. Now, it does have to be what they call a like-kind exchange. Like-kind. Couple important things there. Like-kind means it has to be investment property to investment property, okay? You can't sell an investment property, delay paying capital gains, and put that into a primary residence. Like-kind exchange, investment for investment. It also has to be residential for residential, okay? Now, you could sell one investment property and buy 3 investment properties. You could sell 3 investment properties and buy 1 investment property. That's perfectly fine. Like kind does not mean single family residence for single family. It could be 3 condos for 1 single family, 1 single family for 3 condos. That's perfectly fine. They did come out and say land is not okay. Land does not work. What income are you going to receive from just vacant land? And then again, commercial buildings would not apply either. It's residential investment properties. Okay. Now, mentioned I was going to say it a few times. If you have any very specific questions on this, you really should consult a CPA because there's a lot of gray area when it comes to a 1031 exchange. What I just covered is like what everybody agrees upon. Above and beyond that, it's really kind of up to the CPA's interpretation of this very vague section of the IRS tax code. Okay, so ask a CPA if you have very specific questions. They will differ on their opinions. I've seen people come back with some kind of interesting, unique answers to some of these questions. Yeah, beautiful. All right. That's all good stuff, Aaron. Leverage, diversification, tax benefits, fantastic. Is there any downsides to real estate? Heck yeah. All right. I'm not all rose-colored glasses over here, despite what I do. One of the disadvantages of real estate is liquidity. Real estate is not a liquid asset, right? If you need to sell stocks, you click a couple buttons, you got the money available to you immediately, right? Within a day or two, it's very, very fast and easy. Not the case with real estate. It's extremely illiquid. If you have to get access to the money, you have to do a cash out refinance, which has higher rates. Maybe you have to do a home equity line of credit, which also has higher rates. Typically is an adjustable rate mortgage as well. Or you could sell your asset, right? You could sell that property, but that's going to take time. That's going to incur costs. Speaking of costs, real estate is also expensive to sell, right? It's expensive to sell. It's expensive to buy. There's no way around that, right? It has high transactional costs. When you sell real estate, you typically have to pay real estate commissions. Those can be on the order of, 6-7%. So yeah, there's expenses associated with that. There's also expenses associated with maintaining the property, right? You have to budget accordingly, you have to plan accordingly. You should hopefully have an emergency fund to tackle some of those maintenance expenses, but it's expensive to maintain. And then while it is highly leveraged, again, you can buy a primary residence with 5% down, you can buy an investment property with 20% down, it still requires a significant upfront investment. And this is the single biggest hurdle for most people trying to buy an investment property. If you're buying a $250,000 home, you're probably buying out in like Loch Buoy or something. Yeah, it's going to require 20% down for an investment property. That's $50,000 plus closing costs and prepaids. Yeah, it's expensive. To get your foot in the door, it does require a sizable upfront investment. All right, let's look at a quick example so I can show you how leverage really helps. Okay, so this is a real life example that I did up. Okay, I found the property online, I plugged in all the details. This is reliable. I crunched these numbers very recently. So, whoops, sorry. So if you have a sales price on a house of $320,000 and you were getting a loan amount of $240, in this case, you're putting 25% down. I used an investment property rate of 7.25%. I also assumed appreciation of 5%. Appreciation of 5%, in the last, 12, 24 months, that's probably high. In the last 10, 30 years, it's about right. So it's a solid number to use. So PITIA, what does that mean? Principal, interest, taxes, insurance, and association dues. Okay, PITIA, that's your total housing payment. In this situation, it would be about $2,158. Your initial investment, closing costs, prepaids, down payment, everything, it's about $87,900. To sell the house, I use 7% for costs. Okay, I usually use about 6% for real estate commissions, 5 to 6% there, and then I will add on an extra 1% for seller-related closing costs, tax prorations, title insurance, that kind of thing. 7% is pretty solid. So after 5 years, you'll have collected $8,516 more in rents than you would have paid in mortgage payments. After 5 years, your response to that should be, whoop-de-doo, Basil, that's not a whole lot of money. And you are correct. Disputing that. However, because of appreciation, you will have $181,000 in equity. Minus your initial investment and your selling cost is a net gain of $65,145. Now, here's where it really becomes interesting. If you take this, your net gain in appreciation, and also the cash flow amount you received, this means you'll have made $73,661 in net income, or a return of 83% in 5 years, which over 5 years means annual return of 16.7%. How in the heck is that possible? I mean, it just doesn't make sense. Leverage. It's 100% because of leverage. Leverage. It's what makes these numbers work, right? It's what makes real estate so attractive. You can put down 20%, you can put down 25%, you get 100% of the appreciation. The lender's not capturing any of that, okay? Leverage is what makes real estate so attractive. I've got folks that approach me and I could pay cash or I can, get a mortgage. I'm not a great salesperson at the end of the day. Like, I'm really not going to try to convince you either way, but Yeah, leverage is key. Leverage makes this work. Leverage is what makes this pretty. You could, instead of putting 100% down on one property, you could put 25% down and acquire 4 properties. Like it really does compound on itself. If you had bought that same house in cash, your cash flow would have been significantly more, right? This number would have been significantly more because you don't have no mortgage payment. But your return on investment over 5 years only would have been like 10% because you're putting forth dollar for dollar what you were doing to begin with. Still not bad, still very good actually. However, it does not compete with leverage. Okay. And if you multiply this by 4 and you did acquire 4 properties instead of one, heck yeah. I mean, it really is kind of amazing what happens when you look at the power of leverage when it comes to this. All right. Setting that aside, we'll take a look at some more calculations in a little bit here. Setting that aside, let's talk briefly about the financing and how it differs. Before I do that, Allison, any questions?
There are not any questions right now.
Wow. I'm
Yeah,
shocked.
not yet.
Please bring on the questions. Please bring on the questions. I know you got some. Please bring them on. Everybody will benefit from it, I promise. All right. So how is financing an investment property different? Like I said, one big situation is, hey, you have to do 20% down instead of 25% down. Okay. Most investors, when they get down to the calculus, they find they really do have to put down 25% to make the numbers work. Okay. That extra 5% down will save you quite a bit in regards to the interest rate as well as closing costs. Okay. Big difference cannot be gift funds. Okay. When you buy a primary residence, you can totally get a gift from family for the purpose of buying that house. Not the case with an investment property. Okay. Gift funds are not okay. If somebody did want to contribute money to help you buy an investment property, there's really only 2 paths. One, they join you on the mortgage, then it's no longer considered a gift, it's just their contribution, right? They join you on the mortgage. Or 2, if they were to give you that money and you were to wait for 2 full months, once you go under contract, when we get 2 months of bank statements, it's not going to show any deposits into that account. That's called seasoning of funds. Okay. So if you're not able to document where the money came from for the down payment, deposit in your account, wait 2 months, and then apply for a mortgage because we only request 2 months of bank statements once you get under contract. Anything that happened prior to that, it's not my business. Okay. So that's one way to kind of get around that. We got people that, yeah, I've got cash sitting in the safe at home. Yeah, that's not okay. There's no paper trail on that. So you have to season the funds. Get the funds deposited, wait 2 months, and then apply. Don't hold physical cash, get it in the bank. This comes up all the time. All right, sources of down payment. Savings accounts are perfectly fine. Checking accounts, great. Money market accounts, all those are considered liquid assets, okay? Stocks, bonds, and mutual funds, those are not considered liquid assets, right? They are currently invested. They will fluctuate with the market. Ultimately, for closing, all of your funds, closing costs, prepaids, down payment, everything needs to be in a liquid account. So if it is starting off in stocks, bonds, mutual funds, we're going to have to liquidate prior to closing, okay? Plan on getting those funds into a liquid account. Again, savings, checking, money market. You can actually use a home equity line of credit on a primary residence. The government does allow for you to use a secured loan. Now, secured is the key word there. You cannot use like a credit card, like cash advance, and use that money to buy a house. It's not secured by an asset. It's credit card. It's an unsecured loan. Secured loan would be car loan. You have a car, you paid cash for it, you could just take out a loan against that vehicle and use that money as a down payment. That's actually okay. We do have to take into account that new payment into the equation. Home equity line of credit, you have your primary residence. You can get a line of credit on that house. It's a secured loan, perfectly fine. Once again, if you're using that money for the down payment, I have to take into consideration that extra payment when we qualify you for a mortgage. So secured loans are perfectly fine so long as I can qualify you for it. Now, as I mentioned at the outset, investment properties are considered to have a greater risk of default. So they will have higher interest rates. They're also going to have what they call reserve requirements. We're going to be looking at that on the next slide. Okay. When you buy a residence, you can bring every single dollar you have to closing, and the lender is going to be okay with that. Kind of shocking, but they are. I remember one time bringing literally everything but $5 to closing. And Fannie Mae, Freddie Mac, the government-sponsored enterprise behind the loan, said, okay, great. Not the case with an investment property. With an investment property, the government is worried that you're not going to find a tenant right away. Okay, that's going to take you time to find a tenant, to get it ready to rent out, all that stuff. Because of that, they do require reserves, funds left over after closing. That's all reserves are. To clarify, those reserve funds do not need to be deposited with the financial institution that's doing the loan, Elevation's Credit Union, for instance. They can be in a retirement account or a brokerage account, all perfectly fine. We just have to show that the funds do exist. Okay. Qualification also, we can use 75% of the anticipated rental income to help us qualify. Now, a couple important things there. That 75% calculation, that is going to be based on a signed year-long lease calculation. They're not going to be looking at a mountain home, what would it rent out for like a short-term rental? They're going to be looking at, if this was a signed year-long lease, what do we think this property would rent for? How does an appraiser calculate that? They're literally going to look at rental properties in the area to figure out what that number is. Okay, they're going to review what rentals are going for. They're going to then do it's called a rent schedule. They're actually going to put your comparable rent properties down and show how much these properties are renting for, and they're going to base it on that. Kind of like they do with real estate values, except it's a little bit quicker. Okay, it's not nearly as thorough. I get to use for qualification 75% of that amount. That's the second thing I want to mention. Why 75%? Why not 100%? Government logic, they assume your property is going to be vacant 25% of the year. They don't care that the vacancy rate along the front range is like 4% or something crazy low. Okay, they are looking at better safe than sorry. We're only going to count 25% or 75% of it. So if a property was renting for $1,000 a month, I get to use $750 of that to offset the new mortgage payment I'm giving you. Okay, now that's actually really, really generous in my opinion, only because that means I can qualify you. The higher the price point, the higher the rent's going to be. Like, there's a lot of situations where I can qualify somebody for a more expensive rental property than I could a primary residence because I can add in this additional rental income into the equation. It makes it pretty tenable. Yeah, great. Maybe your mortgage payment on that $1,000, rent situation is $1,000. Maybe you're losing $250 a month on paper for our purposes. Great. If I can qualify you for a car loan, I can qualify you for that, right? So it's actually really, really nice. It helps us out a lot. We use this all the time. All right, let's talk about reserves real fast. So when you're financing properties 1 through 4, yes, the minimum down payment is 20% down. Again, I also have to have reserves. So they're going to calculate reserves based on the unpaid principal balance on any rental property that you currently own. Okay, so whatever rental properties you own, they're going to calculate, so long as you're financing only 1 through 4 properties, 2% of that unpaid balance. I'm going to look at an example here in a second. Plus, I also need 6 months. Again, PITIA, principal, interest, taxes, insurance, association dues. I need 6 months worth of PITIA as well, okay, on the subject investment property. So let's look at an example. Let's say you own 2 rental properties already and your loan balance is $150,000. That means your combined loan balance is $300,000. 2% of that would only be $6,000. Woohoo! And then I also need 6 months worth of your PITIA. In this case, the PITIA is $1,500, so I would need an additional $9,000. So I would need to show $15,000 left over after closing. Closing costs, prepaids, down payment, I would need to show an additional $15,000 exist. Brokerage accounts, retirement accounts, all perfectly fine. Again, it does not need to be deposited with us. Once you get to property 5 and 6 financed, you can still do 20% down. True. Again, 25% down kind of makes the numbers better. I now need 4% of the unpaid principal balance for any investment properties you currently own. I also need 6 months worth of PITIA on the subject investment property. So, similar example, now I own 4 rental properties, each with $150,000. Nice and pretty numbers. $600,000 total, which means I need $24,000. So I need 4%. Still need that $9,000 on the subject. So I need $33,000. Okay. Obviously, these are low loan amounts, but now that you know how we do the math, you can play the home game. Step 10. Now you need 25% down. Okay. Game changes. You might be putting 25% down anyways to get the better rates, make the numbers work, but now you're required to. Okay. I now need 6% of the unpaid principal balance, and I still need that 6 months PITIA. So it balloons quite a bit when you get to properties like 8 in this case. Now I need $81,000 left over after closing. What about above and beyond 10 finance properties? The government says no more investment properties once you hit 10 finance properties. That doesn't mean you can't do it. It means you're going to either have to pay cash or you're going to have to get a non-government backed loan, or they do allow for an exception when you buy a primary residence. So if you had 10 investment properties and you're going to buy a primary residence, perfectly fine. You can have 11 finance properties in that case. And if you decide to turn that property into rental and go buy another primary residence, still perfectly fine. If you're buying primary residences, there's no limitation to how many finance properties you can have. But again, if you're buying an investment property and you already have 10 finance, cash, or you might need to talk to like a hard money lender or a commercial lender. Okay. So things change. We've also seen people like pull equity out of one rental property, pay off a couple mortgages because they're only caring about the finance properties. If you own properties free and clear, they're not taking into account in this. And let's be honest, once you hit properties number 10, we've got some champagne problems on our hand. We can probably deal with it. So, all right. Let's talk about the different types of properties, okay? So single family, detached, right? My current house I'm in, it's detached from other properties, right? Typical suburban neighborhood. Townhomes, they are attached to one another, but they are side by side, right? They typically will share a wall, maybe two, but they're typically side by side, not above and beyond, right? So they don't have neighbors above you or below you. They're typically just side by side. An apartment complex or a condo, right? That's going to be neighbors above or below you typically. That is going to be treated slightly different. Let's talk about condos, right? It's the shortest, entry point into an investment market, condos, because they tend to be the most affordable properties. However, they are also the most challenging to get financing on, okay? So in 2008, when the housing bubble popped, the government blamed two things. They blamed loose lending restrictions, which is honestly why I have a job now, because it's gotten so complicated. And they also blamed condos. They found out that in areas with a high density of condos, Southern California, Southern Florida, Las Vegas, these areas had a high density of condos. When one condo gets foreclosed on, it created an avalanche effect throughout the complex, because now that one unit sold at a short sale or foreclosure sold on the cheap, it drags down the value of the other units, because now if somebody wanted to sell a unit, they're going to have to compete with their neighbor literally next door. So it caused, like I said, a cascading effect in these condo complexes. So the government said, look, we'll still lend on condos, but they have to meet some very specific criteria in order for us to do so. So the rule of 0, 15, 20, 35, and sometimes 50, clunky name. If anybody comes up with something better, let me know. So 0, the complex that you're buying in, it cannot have any litigation currently going on. Why would there be litigation with an HOA? Happens, unfortunately, all the time. Sometimes it's a slip and fall. Somebody slipped and fell. Now they're suing the HOA. It could be, hey, there was builder defects. See that happen all the time. The HOA is suing the builder because of some builder defects that occurred. Very common litigation that's going on. It could be damage that actually happened to the property because of those building defects. Now they're suing the builder. It also cannot be a condotel. So what is a condotel? A condotel is a legal condo, but it also has some features of a hotel. If you go to any of those ski towns, Beaver Creek, Vail, Winter Park, whatever, they have the most amount of condotels. And you'll notice them because you'll walk in, you're like, this kind of looks like a condo, but there's also a front desk where they can like rent it out by the day or the weekend. They also have concierge service potentially. They typically have house cleaning staff on site as well. They will also have what they call short-term rental pools, where if you own one of those condos, kind of a nice setup actually if you're the owner, but it's hard to get financing. If you are one of the owners of one of those units, you can simply let the front desk know, hey, look, I'm going to be out of the property from January through March. And they will actively advertise the property and rent it out on your behalf. And you will receive part of that money. So that's called a short-term rental pool. You can literally just drop properties in a pool and then they will get rented out by the property manager on site. Nice, again, from a homeowner's perspective, but they're hard to get financing on because it falls into condotels. And if it falls into a condotel, you cannot get conventional financing. Okay. Talk about unconventional financing as soon as we wrap up here. 15. The complex cannot have 15% or more of the units be delinquent on HOA dues by 60 days or more. That used to be 30 days. And when it was 30 days, this would come up all the time. Okay. Especially post housing bubble pop in 2008. Also, especially like right when COVID-19 hit. Once they increased it to 60 days, this basically stopped. It's very rare that somebody's 60 days delinquent on HOA dues. 20. The complex cannot have one owner who owns more than 20% of the units, 20% or more of the units. They carve out an exception if there's only like 10 units in the complex. Okay. They also carve out an exception if it's a municipality or a nonprofit that owns those units. Oftentimes, City of Boulder is a good example. City of Boulder will buy up all these units with the intention of renting them out to low-income households. Okay, it's like subsidized rentals, right? Well, sometimes they acquired more than 20%. This guideline is really concerned about if there was a single owner that owned 20% or more, and they fell into financial hardship and they, had to go into foreclosure or bankruptcy, and they're just going to flood the market with a whole bunch of units, the value of those units is going to drop down due to supply and demand, right? Well, they're not really worried about the City of Boulder or the City of Denver. going into bankruptcy. So they do carve out an exception for municipalities owning properties. 35. The complex cannot have 35% or more of the square footage be commercial in nature. Now, why would Fannie Mae and Freddie Mac, and these are all Fannie Mae and Freddie Mac guidelines, why would Fannie Mae and Freddie Mac care about commercial units? Well, commercial units can be vacant for a long time, a long time. I mean, there's some storefronts you drive past for years that are left vacant, right? That's kind of one of the things they're worried about. If you have commercial on the ground floor and then everything above it is residential, well, if that commercial space is all vacant, it could drag down your values potentially, right? I mean, who's going to want to move into a unit when like there's just this empty storefront below it? It's kind of awkward. It's kind of inconvenient. And there's also the additional concern of what's going to go in there, right? It could be a, marijuana shop, and maybe that's your thing and you're fine with the smell, or you might find it noxious and hate it. It could be a restaurant, same thing, right? It could be a bowling alley, be kind of loud. It could be a gun range. That's what they're worried about. They do not want to tie their fate to commercial. Commercial is very volatile. Commercial can be vacant. And with commercial, there's a big unknown of what's going to go in there. So they do have a rule, no more than 35% of the square footage can be commercial. Now, that's the downside of it, and that's how Fannie Mae and Freddie Mac do it. There's also the positive side, which is they could put in a bakery right below, right? And all of a sudden that's really convenient and easy, and everybody wants to live in their bakery, right? So there are upsides to it as well, but Fannie Mae and Freddie Mac, they're government-sponsored enterprises. They're more worried about the downside risk. All right. And then sometimes 50. Of the unit is an investor, and less than 25% is being put down. At least 50% of the units must be owner-occupied. This used to be the case where they did not have this 25% rule, and this would come up all the time, all the freaking time. Since they changed it to if you put down 25% down or more, they do not ask this question. It's gotten a lot better, okay? Prior to that, this was kind of a big problem in our industry. So what if you find a condo and it does not meet these requirements, okay? Then what? Then we have to look at non-conventional financing. If it does not meet these requirements, it would be considered a non-warrantable condo. If it meets these requirements, it's called a warrantable condo. Warrantable, okay? So if it's a non-warrantable condo, you have to find a lender that's willing to do those loans, okay? It just so happens that Elevations is one of the 2 lenders in this area that will do them. We do a lot of non-warrantable condos, like monthly, weekly. It happens all the time. A lot of complexes are non-warrantable for various reasons. So we will do these as a non-warrantable condo. Has to be a portfolio loan. Portfolio loan means it's going to have a short-term adjustable rate mortgage associated with it. Okay, so it might be like a 7-year fixed arm, which means the rate's only fixed for 7 years and then it's subject to change. It also typically has higher rates. Higher risk equals higher rates. Okay, so if you find a condo that's non-warrantable, I wouldn't let it stop you from looking at the property. I would ask why it's non-warrantable. Some of these issues are much bigger than others, right? But I wouldn't let it hold you back, right? There's probably going to be financing options available to you. Elevations, is a likely candidate for that. Let's talk about whether or not you should convert your current home into a rental property. It's the most common rental property people first acquire. They're already living in it, right? And they're just going to convert that into rental and go buy a new one. But a lot of people do this without and thinking about the consequences associated with it. And there are some pretty significant ones. I've converted a property into a rental before that was a primary residence. I still own that to this day. I've also sold a primary residence that I was thinking about converting into rental because when I did this, I did not get the right answer at the end of the day. So jot these down, do this exercise if you're thinking of going this path. Number 1, would you buy it as a rental today? Easiest question you can ask yourself, right? My investment property strategy, and if anybody cares at the very end, I'm more than happy to explain why, but my investment property strategy has always been townhomes, okay? I've always gone with townhomes. 3 beds, 2 baths, something like that is kind of my wheelhouse. When I was looking to convert a single family residence, my first single family detached residence into a rental, I asked myself the question, would I buy it as a rental today? And the answer was no. It didn't fit my long-term strategy. So would you buy it as a rental today? If you're living in a $1.5 million home, there's a good chance you probably wouldn't buy that property as a rental today. It's probably not going to be a great rental property. Who wants to rent out those properties? People that want to buy their own homes, right? So your tenant turnover is going to probably be higher. The risk is a lot greater with that expensive of a home, right? Yeah, so make sure you're asking yourself the question, would I buy it as a rental today? If the answer is no, think long and hard before you consider taking the next steps. Number two, does it require a lot of tender loving care, right? Does it require a lot of maintenance, right? My single family that I was looking at converting, it was going to need a new roof. It was going to need a new water heater. It's going to need a new furnace and air conditioning unit. It also had some kind of deferred maintenance that was coming due. I was like, yeah, it's going to take quite a bit of money, of capital, to really get this to where I want to get to. And also, I wouldn't buy it as a rental today. So make sure you're asking yourself those questions as well. I sold another single family residence. It was a rental property for a little bit, but I was like, it's probably just I'm struggling with it. It required a structural repair. It was a money sink. It was really, really expensive to maintain. I'm like, this is just going to create more anxiety, more stress, and more money than I want to put into it after I've already sunk quite a bit into it. Number three, this one's important. People don't think it's important, but it really is. How emotionally attached are you to the home? You'll see I use the word home, right? There's your house, which is your investment, right? And then there's your home, which is where do you spend your days and nights? Where do you relax? Where can you actually be yourself, right? Your home. How emotionally attached are you to your home? Because tenants are going to freaking live in it. They are going to beat it up. They're going to break screens. It's like a rental car. You're going to drive the rental car a little bit quicker than you drive your own car. Yeah, that's not my car. Yeah. Tenants live in properties and they live in it hard, right? No matter how much due diligence you do, they live in it hard. So how emotionally attached are you to your home? Are you going to be overbearing? Are you going to be the landlord that's calling them every month to do an inspection? They walk through the property and make sure that your home is being taken care of. If so, for the love of all that is holy, do not turn that into a rental. It's not meant to be a rental, okay? That was meant to be a great home. Great. If you want to buy an investment property, buy an investment property. But make sure you're asking yourself that question. And then potential tax implications, okay? For the third, maybe fourth time, I'm not a CPA. However, when you go to sell a primary residence, okay, the title company is going to ask you three questions. Number one, did you live in the house 2 of the last 5 years? If the answer is yes, I have, great. You might be able to protect some of that appreciation from capital gains. Have you lived in the house 2 of the last 5 years? Number two question, did you convert your house into a business? Okay, they're not asking, did you work from home during the pandemic? Okay, I'm working from home right now. They're not asking if you worked from home. They're asking, did you convert your house into a daycare facility? Did you convert your house into an auto mechanic shop? Did you convert your house into a bed and breakfast? Okay, no, I did not. Okay, great. Pat, next, move on to the next question. And then lastly, did you sell any other primary residences in the last 5 years? So long as you can answer those questions in that order correctly. Yes, I have lived here 2 of the last 5. No, I did not convert the house into a business. No, I did not sell any other primary residences in the last 5 years. As a single individual, you could protect the first $250,000 in appreciation completely capital gains free. As a married couple, you get to protect the first $500,000 in appreciation. So if you bought a property for $500,000 and now it's worth $1 million, if you're a married couple, that $500,000 appreciation completely capital gain free, so long as you get to answer those questions correctly. Okay. That was the last thing that I did when I was deciding whether or not I should convert that house into an investment property. And once I got to that time, I'm like, no, that's $200,000. I'm not going to want to pay capital gains on that at 15%. I don't want to pay $30,000 to the IRS. I'm just going to take that money and go do something else with it. And that was investment in the property. So make sure you're looking at the potential tax implications. If you have questions, ask a CPA. But make sure you're asking yourself these questions. Too many people do it and then they regret it after the fact. If you're going to convert a house into a primary residence, my advice would be, I'm all for it. Again, I've done it myself. My advice would be either rent it out for only a couple of years, so you can still answer that first question, yes, I have lived here 2 of the last 5, or rent it out forever, right? You don't want to get caught in the trap where you rent it out for 4 years or 3 years, and now you can no longer answer that question correctly, and now you do have to pay capital gains. That would really stink. All right. So what does qualification look like when converting a primary residence into a rental? If I can qualify you for both your new payment as well as your old payment without adding in any rental income, game on, right? Super straightforward, super easy, great. If you're like most mortals, like myself, and you can't qualify to carry 2 mortgages simultaneously, and I'm more than happy to help you with that arithmetic, we can add in rental income into the equation, but we need a couple things, okay? Once you go under contract on a new house, we would need to get a signed lease on your current property, okay? So new house is property B, your current house is property A, okay? I would need to have a signed year-long lease on property A, that lease would have to go into effect within 45 days of closing on the new property. This one can get a little bit abstract for some people, so I'm going to give you a real example real fast. Okay, let's say you went under contract on February 1st, you were closing on February 28th, okay, 30-day closing, and your loan approval deadline, called loan availability deadline, was on February 21st. Okay, by February 21st, by that loan approval deadline, I would need a signed year-long lease on your current property. Okay, that lease would have to begin within 45 days of February 28th. So it's not like you have to move out of your place and then rent it out. But once you go under contract, you have to advertise for rent, find a suitable tenant, get a signed lease. Okay, we'd have to have all of that by your loan availability deadline, and that new lease would have to go into effect within 45 days of closing. So April 15th in that example. So it's a little tricky. I've seen it done constantly. I've seen it done literally last week with somebody that closed. They did that exact same thing. So certainly possible, but you kind of have to have your ducks in a row and be ready to hit push on that advertising. And hopefully you're not overcharging your friends so you can find somebody that wants to move in and can do this. So signed lease goes into effect within 45 days. Now I can use 75% of that lease amount to help us qualify. Beautiful. All right, so let's talk about tenant management. So I've got a number of horror stories I can tell you. Admittedly, they were in 2008 when everything was really, really, really bad. But you need to carefully evaluate tenants. Do not skimp on this, okay? When I was doing property management in 2008, I would have multiple people applying for properties. A lot of people were unfortunately unhoused, and it was really, really bad situation. There was a lot of fraud going on. I had two different people applying for one owner's property, and I pulled credit. One credit score began with a 4. I'm like, that's not good. 400, that was really bad. For reference, anything over 680 is considered like good. Anything over 780 is considered like perfect. Starting with a 4, like you have to actively work to kind of get there. It was really, really bad. But they didn't have any pets. That was it. 400 credit score, but they didn't have any pets. Compared to the other people, they had a 650-ish credit score, but they had 2 dogs. And when I proposed both tenants to the owner, they said, yeah, we'll take the no dogs. We don't want to hurt our property. I could not get a hold of their previous landlord to verify their references. When I called their employers, the number was disconnected. When they went to pay their security deposit and first month's rent, it was all in cash. Alarm bells going off all over the place. If you can't verify references, do not do it. Maybe make sure you get the right number, but do not do it. Okay. If the credit score is too bad, don't do it. Okay. If they're trying to pay their rent in cash, don't do it. No, I'll advise, take it as you will, but I've seen this go sideways too many times. Okay. Whenever I rent out properties, I view it as a mortgage application. I want to see 620 credit score. That would mean we could get potentially FHA financing, right? 680 is what I like to see above that. But if I had to, 620, okay, I can work with that so long as there's a good reason. I also need to verify references. They better be paying with a check because I need to make sure it clears. And if you don't have a checking account, that's a bad sign, right? So make sure they're completing a full application. Make sure you're checking their references. And if your gut instinct says, oh, I feel like something's off, don't do it. Don't do it. Trust your gut, right? Protect your investment. Be very clear with expectations up front. Okay. How often are you going to be doing inspections? It's not unreasonable to want to inspect the property, twice a year. That's not unreasonable. I use a property management company now. They inspect it twice a year, spring and fall. It's great. And they use it as a way of keeping that relationship intact, right? They pitch it as a good thing. Hey, we just want to do a quick inspection, make sure that nothing's wrong, check in with you, make sure you don't need anything in the property. Sometimes the tenant comes back, oh, this light switch is working a little. Great, we'll add that to the list. We'll take care of it for you. They use it as a selling point. We're here to help you out. We're here to take care of your property. Great, you need their buy-in to do so, but manage those expectations up front. Inspect the property quarterly. That's maybe a little bit aggressive now. At least twice a year, so it's definitely not aggressive. Bare minimum once a year, but a lot can happen in 12 months. So start with a solid lease. If you're using a property manager, they will have a preferred lease. If you're not using a property manager, you can find some online. The Boulder model lease, if you just do a quick Google search for that, that is a typical lease that we see in and around Boulder. That's a pretty solid lease as well. Most property managers will have some variation of that they use. Use a professional for taxes, if not always, at least for the first year. They're going to tell you whether you should take depreciation at the beginning. They're going to tell you how to set up your Schedule E for future use as well. And then, as with all relationships, you get out what you put in. Be responsive. If they need something from you, be responsive. The more quick you are to respond, the more likely they are to stay there. And I come across this all the time. I've got people, landlords, that are like, yeah, I'm really going to try to push the market on the rent this time. Fair market rent is $2,300. I'm going to charge $2,500 and really see what I can do. Sure, but if that property is vacant for even 1 month, you've lost out on all that extra income received, right? So I do the opposite. I actually undercut the market slightly on my rental amounts so that I can have my pick of the litter. I want multiple applicants to choose from. I want to really have my property manager compare those and say, hey, great, here's 3 great candidates. Which one do you want? We want to move forward with this one, but what do you think? Heck yeah, I would much rather have my pick of the litter than being stuck with only one bad option. And if you only have one bad option, kick the can. Wait, a bad tenant can absolutely destroy your property. I've had tenants, again, 2008, a long time ago, but those same tenants that paid cash for that security deposit and first month's rent, when they never paid another month's rent, when we finally evicted them and walked through the property, they had burned cigarettes out on the carpet. Surprised they didn't burn the house down. They had punched holes in the wall with a nail gun. They had stolen a furnace. They destroyed the property, and there was red flags all over the place. Landlord turned out they were okay. They had an ample insurance. That's another thing you should always have is sufficient insurance, landlord insurance policy, an umbrella policy. Umbrella policies are very affordable and they give you a lot of coverage. So I'd recommend looking into both those. And then know yourself. If you cannot do one or more of these things, then you need to hire a property management company. Okay. And that's ultimately where I ended up. I was way too emotionally involved with my rental. Okay. It was my first home. I was too close to the situation. I literally invited my tenants to my wedding. That's not good. I remember being at the wedding and like, hey, we've got great news. We're pregnant. I'm like, I can't increase your rent next month. Like, I can't do it. Too close to the situation. I was inviting them to, I was never increasing the rent. I was never doing the inspections. I just trusted them way too much. Know yourself. If you cannot do these things, hire a professional to handle it for you. Okay. A good CPA is going to save you more money than they're going to cost you, right? A good real estate agent is going to save you more money than they're going to cost you. A good property manager is going to save you more money than they're going to cost you. When my property managers got brought in, bam, they started charging fair market rent instead of undercutting the market as much as I was. They started doing, twice a year inspections to make sure that everything was good with the property. They were taking way better care of the property. They were creating so that there wasn't as much tenant turnover. A good property manager is going to save you more money than they are going to cost you. Okay. They will evaluate tenants on your behalf. They will present options to you. They will do the credit report, the reference checks, all of that for you. They will figure out who they work for, what job do they do, how much debt do they have, what their credit scores are. They're going to handle all that for you. They will perform routine maintenance. I absolutely love getting that email from my property manager saying, hey, by the way, the water heater broke on this one. We shopped it around. We got 3 different quotes. We chose this one. It seemed to be the most affordable. Hope that's okay. You're going to know your next month's rent is going to be a little bit lean. That's so much stuff I didn't have to deal with, including that 3 a.m. phone call of our water heater broke. Heck yeah. So they will perform routine maintenance on your behalf and at your expense, of course, but they will take care of it for you. Average cost, it's going to differ property management company to property management company. Most for a long-term rent, we're going to charge 10% of the monthly rent. Okay. So if you're getting $1,000, they will take, 10% of that. They will also take typically around 50% for the first month's rent. Show the property, advertise the property, take pictures of the property, do the check-ins, do the checkouts, handle all that, references, credit reports, all that. Okay. If it's a short-term rental up in the mountains, for instance, those property management costs are going to be far higher. Okay. Short-term rental, they have to change the sheets every 3 days or however long, right? It's basically like a hotel. Because of that, it's going to cost, around 40 to 60% for short-term rentals. There's a lot more that needs to be done. Now, regardless of whether or not you have a property manager or not, you have to comply with the local laws. Okay. You need to know this. You can't be discriminatory against religion, sex, marital status, right? You can be biased against pets, although they're awfully cute. That's one thing you can be biased against. Credit score is not a protected status, so you can certainly be biased against that. You cannot be biased against disabilities either. If they require a wheelchair and your property is not currently ADA accessible, You have to make accommodations for that. You cannot just immediately rule it out of, hey, we're not going to do this because our house is not ADA compliant. No, it's on you to make it ADA compliant. Habitable housing. When I was in college, we didn't have any heat in our property, and I was living in the converted garage. I almost got frostbite multiple times. Like, that's not habitable housing. That's called a slumlord. Don't be a slumlord. Security deposit limits and return rules. You need to know all this. Disclosure of lead-based paint, other hazards. Was your house used as a meth lab? Yeah, there's a lot of things that kind of go into this. When you hire a property manager, they will walk you through all this, and they will ask you to fill out disclosures to tell them what you do and do not know about the property. So they will handle most of this. If they're a licensed real estate agent, they take in some property manager courses. It's part of the real estate education process. All right, setting that aside, let's talk about some analysis. This is where, if you're a money nerd like me, you're really going to enjoy it. If you're not, I am so sorry for the next couple slides. All right, so let's look at a townhome. Okay, so this is a townhome. Real life example, $385 was the sales price. This was a townhome in Westminster. Down payment was 25%, principal and interest, taxes and insurance, HOA dues, total monthly cost, right? What we call PITIA. Now, your monthly rent on this house, I did a quick search. When I look up rental income or rental amounts, I go to a couple different resources. One is Craigslist. Shocking, but it's a really good resource. So many people advertise properties for rent there. Craigslist, super solid when it comes to actually looking at rental amounts. You can also drive around the neighborhood. Is there any for rent signs? Great, pick up the phone, give them a call. Another option, it's a website, it's called Rent-O-Meter. Rent-O-Meter, so jot that down, Rent-O-Meter. It tries to do for rental amounts what Zillow does for real estate prices. They look at comparable rents in the area and try to predict what the value is worth. Now, Zillow is going off public records, right? It's black and white. Every sale is in public records. Very black and white, very clear. Here's the square footage, public records. Here's the beds, baths. Here's how much it sold for, all in public records. Those estimates that they create is based on that, right? Well, the rental data is not as clear, okay? There's not public records data for all that. So they're going to instead give you a range. Hey, we think that property rent between like $2,250 and maybe $2,750. It's going to be a range. They will show you comparable properties in the area. You can use Rent-O-Meter a few times before they want you to sign up for an account. So use it, frugally. Otherwise, you're going to have to pay for it. But anyways, it's a good resource as well. So anyways, net income, $60, right? $2,600 minus $2,535 is $65. Or is it $335? This is a really important note. Okay, and it kind of shows up as a flaw with all the different calculations as to how much a property is going to give you as a return. What's the 335 number? It is the net income, sure, the $65 plus how much your loan is getting paid down on a monthly basis. When you have a rental property, yes, you're paying the mortgage, but the tenant's then reimbursing you. Effectively, the tenant's paying your mortgage, hopefully, right? How much of that is actually going towards principal versus interest? Okay, due diligence, I always look at how much is being paid towards principal on my mortgage, and I include that as potential cash flow. Yes, bank statement. It's not going to show ingo and outgo is going to be that $65, right? But that remainder of that money is like a long-term CD. I'm eventually going to reap the benefits of it, right? It's just sitting there. And my wife and I have this conversation a couple of times. Like, why do we have all these rental properties? And like some of them aren't even cash flowing. Like, yes, but they're on 15-year mortgages. And that's a good thing. It means that while we're not cash flowing on paper, I am cash flowing in reality, right? It exists. It's paying down that loan. And with a 15-year mortgage, it was really paying down that loan pretty aggressively. So it's not cash flowing on paper. In fact, it was like negative $100 until you looked at how much I was paying towards principal. I was like, hey, this is cash flowing $700. As long as you can stomach it, it's pretty nice. So take into account, in my opinion, how much you're also paying down the loan. How much is that actual principal payment? Now, a couple notes, things you need to be aware of. This does not assume any vacancy, right? Yeah, you kind of need to factor in some vacancy. It also does not factor in any maintenance, right? You should budget for that too. A rule that you'll hear thrown around is whatever your housing payment is, so 25, 35 in this case, you should set aside about 10% for future costs, maintenance costs. That's an imperfect rule, right? If your house was built in 1900, you probably should be setting aside more than 10%. If the house is brand new construction, might not want to turn it into a rental. But if you did, yeah, your maintenance costs are going to be far lower, right? So not a perfect rule, but it is a rule that people throw around if you need a figure to go off of. Not a bad way to start. In this scenario, again, 5% appreciation, 7% selling costs. You'll have made $83,000, 79% return over 5 years, or 15% per year. Okay. Leverage, leverage, leverage is what makes this all work. Now let's look at a single family residence in Longmont. Okay. So 459, it's a single family residence, which means it's a higher price point, 25% down still, lower HOA dues. It's kind of like one of those nominal kind of suburban neighborhoods where the HOA dues exist, but it really just kind of takes care of like green belts. Total monthly cost for $27.33. Monthly rent was $27.50. Single family home, so I can charge a little bit more. Cash flow, either $17 if you're literally looking at the difference between this, or $339 if you're taking into account the amount you're paying towards principal each month. Again, does not assume any vacancy or maintenance. I use 7% appreciation on this scenario because single family homes appreciate more than condos and townhomes do. You will not see a lot of people doing fix and flips with condos or townhomes, right? You will see people doing fix and flips with single family residences. Again, what's your priority to start off with? Is it cash flow or is it appreciation? If it's appreciation, you should be aiming for single family homes. Single family homes appreciate more than townhomes. Townhomes appreciate more than condos do. Okay. So again, what's your priority to start out? Also, with single family homes, those do tend to have a higher tenant turnover. People that rent single family homes tend to want to buy their own property in the next year, 2, 3. Maybe not the case. You could have a tenant forever renting a single family home, but traditionally, those that rent condos or townhomes tend to renew their leases more often than somebody that rents a single family home. In this scenario, you would have come out ahead 23.82% because of leverage. Leverage, leverage, leverage. All right. So let's look at a couple real quick calculations as to how to compare different rental properties. And then we're going to wrap up with some questions and yeah, call it a day. So there's 2 different calculations you can do when it comes to comparing rental properties. One is what they call a cap rate. The other one is what they call a gross rent multiplier. 2 different calculations, both imperfect. I'll be talking about why they're imperfect in a second here. But I always run these calculations whenever I'm looking at rental properties. Okay. So the cap rate, it allows you to compare the net return on different investments based on the purchase price. The higher the number, the better. Okay, so it's going to be the net rental income. I use the including the principal amount on these scenarios. Otherwise, these numbers are blown way out of proportion. So I use the principal payment as well. Multiply that by 12, divided by the sales price. You want the higher number better, which in this case would mean that the townhome would be the better property. Okay, it's got the higher of the 2 numbers. Makes a lot of sense. The cash flow is very similar, but the prices are not. Okay, and why is this not perfect? Talk about that in just a second, but you'll see one glaring issue with this. I should always buy townhomes in this case. Maybe, maybe not. Other calculation you can do is what we call gross rent multiplier. So it allows you to compare the purchase price to the rents before the expenses. In this case, the lower number is better. Okay, so we take that monthly rent, multiply it by 12. We take the sales price, divided by that. Again, the lower number is going to be better, which would tell us here again, hey, the townhome has the lower number. Run both equations on all these properties, but it does allow you at least try to compare apples and oranges. Single family home versus a townhome, right? This tries to kind of cut to the quick and kind of get ahead of it and let you do compare those imperfect, properties in an imperfect world. Now, what are the issues? Okay. Well, neither the cap rate nor the gross rent multiplier takes into account appreciation. In our example, single family homes appreciate at a higher rate than townhomes or condos do. Yeah. No wonder the townhome numbers came out ahead on both fronts because it's not taking into account appreciation. You should, right? This is not a perfect calculus, not a perfect equation. It's meant as a tool you can use. It's certainly not perfect. Neither calculation takes into account a vacancy factor. Well, yeah, a townhome is likely going to have less turnover than a single family home would. So it doesn't take into account a vacancy factor. Nobody knows what that's going to be, right? Here's another issue. Number 3. Cap rate may make the numbers look deceivingly bad if you're opting for a shorter term mortgage, right? The cap rate is your cash flow. And if you're not taking into account the principal, as I do, this is imperfect. It's going to show a 15-year mortgage would have, significantly worse numbers than a 30-year fixed. That's not necessarily the case, right? I've already talked about how you pay yourself much more principal when you do a 15-year mortgage. Gross rent multiplier does not take into account the maintenance costs. Yeah, also true. Single family home is going to have higher maintenance costs than a townhome because with a townhome, you've got HOA dues. With a townhome and HOA dues, the HOA is maintaining the outside of the building, siding, roof, common areas, all of that, right? Not the case with a single family home. That's on you, unless you're buying like a patio home. All right, I did this entire seminar with not a single dang question. Now's your chance. Who's got questions? Here's all my contact information as well. If you have a question, but it's a little bit more private and you want to take it offline, there's my email. Jot it down. I love answering questions. Honestly, it's my favorite part of what I do. So you guys are all kind of making me sad right now. All I want to do is answer some questions. Joking. Hit me up if you have any questions at all. Anytime. I love this kind of thing. If you can tell, I'm a nerd. So yeah, Allison, you got anything?
I don't have anything right now. No, did great.
Thank you. Is that a question? Just a high five?
I think it's a high five. Yeah, unless they're raising their hand. Oh, here we go. Let's see.
What do you got?
How do you find a property manager?
Great question. Love that question. If you want to email me, I'm more than happy to send you a couple names and numbers. A lot of real estate offices will have a property manager there. They tend to be like kind of a dual service. Like, yeah, we represent buyers, we represent sellers, and we also have a department that will handle, property management. So maybe you want to start with your real estate agent and ask them. If you need some names and numbers, I'm more than happy to pass along a couple. They're not Elevations endorsed, nobody is, but I'm more than happy to pass along a couple that I have personal experience with and have had great experiences with. So shoot me an email. I'd be more than happy to send you some names and numbers. Great question. What else?
Do you see it more difficult to rent out a fully furnished place?
Fully furnished place. They serve very different markets, is what I would say. So, sorry, getting back to, I've gotten too far again. They serve very different markets. So fully furnished place tends to be corporate housing is the most common, right? It's a big corporation that is trying to, have short-term rentals for people that are coming in, interviewing for jobs, spending the night. Like, it's a nice perk that they can offer. Traveling nurses is another one that was very popular during COVID-19. So that's another arena. They're definitely less common. More people have their own personal belongings. So fully furnished is pretty rare. Harder, no, but it's a very different market that you're trying to serve, a very different market that you're advertising to. So not necessarily more difficult, but very different. You also get to charge a little bit of a premium for it. Obviously, with short-term rentals, they're all going to be fully furnished. That's kind of taken over that marketplace in a lot of ways.
All right.
What else? It
looks like, I think that may be it. I don't have anything else on Q&A or on the chat.
Those things, anything else, let me know. Yeah, thank you so much. Appreciate you.
Awesome. Thank you so much, Erin. Have a wonderful day, everyone.